All right, pause your scroll for a second and stay with me, because something big just happened and most people are completely misunderstanding it. In the last 24 hours, silver didn't just dip, it fell off a cliff. We're talking about a negative 21.5% move in a single day. Roughly $6.5 trillion evaporated across markets, with about $1.4 trillion wiped out from silver alone, as prices collapsed from around $120 an ounce down to the high 90s. And here's the part that matters right now. This didn't happen because demand disappeared. Both futures positioning data and physical pricing out of Asia are already confirming that. The real trigger isn't what you think it is, and if you understand it, you'll start seeing these moments before they hit headlines. Stick with me, because I'm going to walk you through exactly what just broke, why it broke, and how you can recognize this pattern next time before the crowd panics. Before I explain what caused this, let me teach you something most people never really internalize about markets. Price isn't just supply and demand. Price is supply, demand, and leverage layered on top. Think of leverage like stacking furniture on a glass table. It looks fine. Everything seems stable, until one small crack spreads. During silver's run from roughly $60 to $120, leverage quietly exploded. Futures traders piled in, margin got cheaper relative to gains, and momentum traders started chasing price instead of value. That's normal in parabolic moves. But here's what most people miss. When a market becomes crowded with leverage, the real risk isn't bad news. The real risk is math. When prices move fast enough, margin requirements don't care about your conviction. They care about your account balance. And when those balances get hit, selling becomes mandatory, not optional. It's not emotional, it's mechanical. And that difference is everything. So what does that tell us? It tells us that the most dangerous moments in markets aren't always about fundamentals changing. Sometimes they're about structure collapsing. And if you're following along and this is making sense, drop a comment below. Let me know if you've seen this pattern play out before in other assets. Now here's what's actually happening under the hood. Let me break down the sequence because this matters. Silver rallied hard, fast, and almost vertically. As that happened, open interest surged and leverage ratios crept higher. Then liquidity thinned. That's key. When fewer buyers are sitting underneath the market, even a modest wave of selling can move price violently. So when silver slipped just enough to trigger margin calls, forced selling kicked in. That selling pushed price lower, which triggered more margin calls, which forced more selling. That's the cascade. It's mechanical. It's not emotional. It's pure math executing itself across thousands of accounts simultaneously. And here's what's wild about this. While paper futures were getting obliterated on COMEX, physical silver prices in Shanghai barely blinked. In fact, premiums stayed elevated. That divergence is your tell. When paper collapses but physical holds firm, you're not looking at a demand crash. You're watching a leverage flush. Now let me show you what most people are missing. Those flushes tend to exhaust sellers faster than people expect. Here's why. Forced liquidation isn't infinite. It's finite. Once the leveraged positions are cleared out, once the margin calls are met, once the weak hands are shaken out, the selling pressure disappears almost as quickly as it arrived. And what you're left with is a market that's been reset. The paper side got cleaned out. But the physical side? The physical side never panicked. And that's the confirmation you need to watch for. When futures open interest drops sharply, that's leverage leaving the system. When physical premiums stay elevated or even rise during paper sell-offs, that's telling you real demand is still there. It's just hidden under the noise of forced liquidation. But here's the part that should make you pay attention. This isn't theoretical. This has happened before. And when you see the pattern, you'll recognize it immediately next time. In 2008, silver collapsed over 50% during the liquidity crisis. People thought it was done. They thought the bull market was over. What happened next? Silver went on a multi-year run afterward, eventually climbing from the low teens all the way past $40. Same pattern we're seeing today. Leverage built up, crisis hit, forced selling dominated, and then repricing began once structure stabilized. In 2011, after a parabolic spike, silver crashed nearly 30% in just days as margins were raised and leverage unwound. That wasn't the end of volatility, it was the reset. And in March 2020, silver was smashed during the global dash for cash, even as physical supply vanished and premiums exploded. Dealers couldn't source metal. But futures kept dropping because traders needed dollars, not silver. Every time this setup appears, extreme leverage, sudden margin stress, paper selling overwhelming thin liquidity, you get violent downside first, then stabilization, then repricing. Zoom out, and you see the larger story. These are mechanical events, not fundamental verdicts. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this keep going lower? Of course. Forced selling doesn't stop just because it should. Could there be more liquidation if broader markets stay stressed? Absolutely. And here's the thing about manipulation narratives. They don't help you trade or think clearly. Markets don't need villains to behave brutally. Structure alone is enough. So instead of arguing motives, focus on signals. Focus on stabilization zones. Focus on whether physical markets confirm or reject paper prices. That's where your edge lives. That's where you actually learn to read what's happening instead of reacting to what already happened. There are probably 3 types of people watching this right now. Maybe you're the first type. You don't own silver. You're just trying to understand why markets can lose trillions in a day. If that's you, the lesson here is leverage. Anytime you see vertical price moves paired with record participation, start asking where the exits are. Start asking what happens if everyone tries to leave at once, because that's exactly what we just watched. It's not unique to silver. It happens in crypto, it happens in tech stocks, it happens in any asset that gets crowded with borrowed money. Your job is to recognize the setup before it unwinds, not after. Maybe you're the second type. You own silver and you're feeling punched in the gut right now. That's real. I get it. Watching 20% disappear in a day is brutal, especially if you didn't see it coming. For you, the focus shouldn't be panic. It should be whether this move breaks long-term structure or just resets positioning. Ask yourself this. Did the fundamentals that made you buy silver change? Is central bank buying stopping? Is currency debasement reversing? Are supply constraints disappearing? If the answer is no, then what you're seeing is noise, not signal. It's painful noise, but it's noise. And if you bought for the right reasons, this is where conviction gets tested. And then there's the third type. You're actively looking for opportunity. You're watching this thinking, is this the dip I've been waiting for? If that's you, patience is the skill. These events don't reward speed. They reward confirmation. Don't try to catch a falling knife just because it fell. Wait for stabilization. Wait for physical markets to confirm. Wait for open interest to stabilize. Wait for the forced selling to exhaust itself. Because here's what I've learned. The best entries after leverage flushes don't come at the bottom tick. They come when structure reasserts itself and you can see the market finding its footing again. No matter which camp you're in, the universal principle is the same. Price alone never tells the full story. Structure does. So here's what I want you to answer in the comments. Which type are you? Are you watching from the sidelines trying to learn? Are you holding and trying to stay calm? Or are you looking for entry points? Let me know, because understanding where you are helps you make better decisions. Now here's where I stand. I'm not panicking, and I'm not blindly buying the dip either. I'm watching. First, I'm watching the $95 to $100 zone for stabilization, because that's where forced selling often burns out. If silver can hold that range for a few days without retesting lower, that tells me the cascade is probably done. Second, I'm watching Shanghai premiums. Sustained levels above 20% historically matter. If physical buyers in Asia keep paying big premiums over spot, that's your confirmation that real demand never left. It just got buried under paper selling. Third, I'm monitoring open interest. When leverage stops falling, the flush is usually close to done. You can track this in real time through COMEX data. When those numbers stabilize or start ticking back up, that's when you know the mechanical pressure is off. Based on my analysis, this event was structural, not fundamental. The fundamental picture for silver hasn't changed. Central banks are still buying gold and diversifying reserves. Currency debasement is still happening globally. Industrial demand for silver in solar, electronics, and batteries is still growing. Supply is still constrained with major mines facing declining grades and rising costs. None of that changed in 24 hours. What changed was that too much leverage stacked up, liquidity thinned out, and math took over. That's a reset, not a rejection. And if history rhymes, this is the part where markets feel the most uncomfortable right before direction reasserts itself. The move that follows these flushes is often sharp in the opposite direction once confidence returns, and buyers realize the forced sellers are done. Now, I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I'm saying against your own analysis. But here's what I'll tell you. If you made it this far, you're thinking critically instead of emotionally. That mentality will serve you well. Most people panic when volatility hits. Most people make decisions based on fear or greed in the moment. You're here trying to understand structure, trying to see the pattern, trying to build a framework for how to think about these events. That's rare and it's valuable. So if you found this helpful, share it with someone who needs to see it. Subscribe if you want more breakdowns like this when markets get volatile. And remember, your job isn't to predict every move. Your job is to understand what's happening, recognize the patterns, and position yourself accordingly. Stay sharp out there. Think critically, verify your data, and make your own decisions.